Hi everyone, I'm Jason with Level Up Investing, and today I am socially distancing myself. I'm here at the park across the street from our house, and I wanted to do this video today to go over the Walt Disney second quarter and 6-month earnings report that just came out today. So I just listened to the entire earnings call, and here are some of the highlights that I got. So by the way, today is May 5th, 2020. And so some of the key points that they brought up, first of all, the most glaring thing is that for this second quarter, the net income from continuing operations has dropped 91%, from about 5.4 billion a year ago this quarter to 475 million. So 91% drop in net income from continuing operations. Diluted earnings per share also from continuing operations dropped 93%. So this was quite significant, which we knew would happen. The free cash flow also dropped by 30% year over year. And other items of interest, when they broke it down by the different segments, the media networks did well year over year at 28% increase, but what's interesting is the direct-to-consumer, the Disney Plus, which I figured would be the one that would save them. Well, let's see, the direct-to-consumer revenues were up way above 100%, but the operating income from the direct-to-consumer was down way above 100%. Year before it was at a negative 385 million, and this quarter it was a negative 812 million. So they go over it in detail into the release of the report, as well as the call. They talked about it, where they said the increase in operating loss was due to costs associated with the launch of Disney Plus and the consolidation of Hulu. So during this call, someone asked, what is your forward thinking, what is your guidance on the eventual profitability of the streaming service? And the leadership basically said that there was no guidance on profitability, and also that they're still launching in new markets. So whenever they're launching in new countries, then there's going to be a whole lot of expenses, and so that's why the operating expense, even though the revenues improved, the operating income rather was significantly decreased over this past quarter. So that was a key point. And one of the big things I wanted to know was the parks. So you have parks closing, not just in Asia, but also Disneyland and Disney World in the US here. What the numbers showed was that the total segment operating income from the parks, experiences, and products decreased year over year by about $1 billion. So it was a 58% drop compared to last year in operating income for the parks, experiences, and products. So that alone is well, you kind of would expect that with the parks closing, but what they pointed out in the call was very important. They said, keep in mind that the closures of the parks in Asia, although that occurred in January of this year, the US parks have only closed in mid-March for both Disneyland and Disney World. So this $1 billion drop only takes into account just a couple weeks worth of domestic closures. So that's, to me, a bit concerning, because then over the next couple quarters we should see some significant changes, some significant decline, I would expect, if the parks continue to close. They did have a bright spot. They did mention that the Shanghai Disneyland is going to open on May 11th, coming up here, but it's going to incorporate a lot of social distancing and people wearing masks, and significant lower percentage of actual customers that they're going to allow in there. So it's going to be quite interesting how the recovery is going to take place, and how long and how drawn out this recovery is going to be. The other big bombshell they really left was that the the company will be foregoing the dividend, that's the semi-annual dividend that's supposed to be in July. It was supposed to be 88 cents per share, so they are foregoing that dividend to the tune of about $1.5 billion in savings that they're going to need for this these coming months. So this was not really a surprise, but some of it was a surprise, I thought. But also keep in mind that the decline in the park's operating income only took into account a very short amount of closure in the U.S. market and the elimination of the upcoming dividend. So it's just an update based on the earnings report for this quarter, and it's also important to consider that for future investment in Disney. I'm still looking at Disney as a long-term play. I will continue to watch the numbers, especially for the Q3 earnings, how that's going to look. I'll be watching the stock price, and as it gets closer to my buy price, then I'll be purchasing more of the company, because I do believe in the company in the long term. It's just going through a very tough time right now. If you haven't seen my previous video on Disney and my approach, I'll put that link up here in the corner, and you can check that out as well. But for now, I will go ahead and continue to follow Disney, and I'll give you an update at the next quarterly review, at the next quarterly report. So if you like this content, definitely give a like to the video, subscribe, and hit the notification bell, and you'll get these videos as they come up. And I'll see you on the next video.